This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a Mackenzie Investments podcast. I'm your host, Dustin Reed, Chief Fixed Income Strategist at Mackenzie in Toronto. We like to anchor these discussions around North American central bank meetings. Earlier today, we had the Bank of Canada meeting and press conference for July, and we will chat about that in a few minutes. But first, maybe a few thoughts around markets. It's been a very interesting and important week in the macro space, and there's definitely a few things to talk about and take a look at. Obviously, over the last week or so, we've seen a spike higher in oil and natural gas prices as the hostilities in the Middle East have once again resurfaced. The U.S. getting a little more aggressive with Iran, and Iran obviously coming back and focusing on some of the Gulf Coast countries. We're also seeing more incursions within the Strait of Hormuz, with ships being targeted, and the U.S. has obviously imposed a blockade, in theory, on Iranian ports and ships, both for entry and exit from the Strait. This has caused a few commodities, particularly oil, of course, and Brent being the global benchmark, to move higher from the low 70s last week to around 85-ish as we record here Wednesday afternoon. And this is interesting, of course, in the juxtaposition of the US CPI data that printed yesterday, Tuesday, for June, of course, early July print for June. And that data, of course, as most people I'm sure have seen, came in quite weak, quite a bit weaker than expected, about minus 0.4 on the headline and about flat on core. It was quite an interesting release and quite a surprise to the market, not only because it was lower than expected, but because it missed by so much, particularly versus some of the aggregate indicators like the CPI fixing market, which is a niche market and usually is a pretty good relative and absolute indicator, directional indicator of where CPI would print. This was probably the third largest miss in the last 6 or 7 years, at least, with the previous two bigger or larger misses happening just at the beginning of COVID. And of course, last year, around the US government shutdown, where we had not full data from the Bureau of Labor Statistics in the US. So in terms of a normal month, as it were, this was probably the biggest miss that we've seen in many, many years. So it was a little bit surprising. So again, the headline down 0.4, core at 0, seems to suggest that food and energy, and I would say mostly energy prices, were the main cause of that decline. Obviously, oil prices were off a lot in June over May, which was the capture period. And we saw that, of course, at the price at the pump in the US and, of course, here domestically in Canada, as one would expect with oil coming off significantly when the US and Iran were having more constructive dialogues back and forth, either in Geneva or in Islamabad or elsewhere. But obviously that seems to have, for now, unfortunately, gone by the wayside. And so we have CPI data that is somewhat stale, not entirely stale, but somewhat stale compared to where we are with the current spot price in oil, like I was saying a minute ago, around $85 a barrel. So the market's kind of caught a little bit in the middle here, obviously looking at data that isn't super stale, but is somewhat stale given what's happened over the last week or two or so in the changing geopolitical environment. So that makes things a little bit tricky, I think, from a macro econ and a markets perspective. I think the big question that I've had, and it's only Wednesday afternoon here as we've recorded during a very important macro week, but is this inflation data the beginning of a trend? And I would say that I would be on the hawkish side of that, effectively saying that I don't think it's the beginning of a trend. I think that there are enough price pressures in the pipeline, or inflationary pressures in the pipeline, that will keep inflation from becoming a disinflationary trend or deflationary trend, depending how you look at it, and keep inflation somewhat frothy here in the months ahead. Anything in economics, almost anything in economics and markets is not in a straight line. And I think that that's exactly what's happened here with the June data and the CPI data. So this idea that the market needs to reprice for cuts by the Fed, I think is a little premature. When you look at things a little bit more granular, but when you look at things like the crack spreads, which are basically the difference between what spot oil is trading at and what the refined products are trading at, like gasoline or diesel, depending on the metrics that you use, but a lot of them are at cyclical highs or close to cyclical highs. which basically means that it's still expensive to buy products, still expensive versus just spot oil. So it's expensive to buy diesel, it's expensive to buy gasoline, it's expensive to buy those refined products. And I think that because those refined products are clearly what most people end up paying for, real retail consumers, as opposed to traders that are trading, spot or Brent futures, the near month contract for Brent futures. Those higher prices are going to find their way into, prices of goods and services, so cost of goods sold and that sort of thing. And so it's tough for me to see inflation take a significant move lower here. And maybe inflation doesn't move as high as I expect, but I think this idea that's popped up over the last week or so that inflation is going to start moving lower and we're at the beginning of a trend, I think it's a little early. The counter to that clearly is US. When you look at 2-year CPI swap spreads or inflationary swap spreads on the 2-year basis, they are effectively at cyclical lows. So you have a really interesting dynamic here where you have one of the traded markets that's relatively liquid and relatively deep, saying the 2-year CPI swaps, inflation swaps, are going to be quite low, and the risks around that are around 2.5 or 2.6%. But headline inflation and what's happening with the crack spreads and prices for product, diesel, gasoline, those types of things, particularly against spot Brent and spot oil, is at, again, depending on the metric, close to or at cyclical highs. So it's a bit of a divergence. And again, kind of goes back to what I was saying before, markets are caught a little bit in the middle here, at least from a fixed income perspective. I think one of the reasons why we're seeing that is because Fed speakers continue to be not entirely one-way hawkish, but certainly key people are generally leaning hawkish. We had a speech from Governor Waller, who is clearly one of the leading macro thinkers on the committee, if not the leading macro thinker on the committee. And he spoke Monday, and again, pre CPI data to be fair, but he was certainly advocating for a hike if the CPI data came in hot. And he also said, which was kind of glossed over by the market a little bit, but if we had a weak print, which we obviously did get subsequently 24 hours later, we would need to see a number of consecutive weak prints before the hiking bias in the Fed would probably need to go away. And we've also had Chairman Warsh, who's obviously still relatively new to the job, in front of Congress yesterday and today, Tuesday, Wednesday, yesterday, Tuesday in front of the House, today, Wednesday in front of the Senate, doing the semi-annual, what used to be called the Humphrey Hawkins testimony, but now it's just the joint testimony to monetary policy update to Congress. And he certainly did not come out dovish, suggesting that rates were going to be lower, policy rates were going to be lower anytime soon. Some of the things that Warsh said included doubling down on getting inflation back to 2%. And presumably that is core PCE inflation, which is for now the Fed's preferred mandate, which is currently running well over 3% on an annual basis. He also continued to defend the idea that inflation cannot continue to be running at this pace for this amount of time because it's not particularly constructive for the economy. Some of the other things he said included that the labor market was in pretty good balance, which is something we've been saying for a bit. The quote was, as we look out the window now, the labor markets look to be in pretty good balance, but we've got some work to do on the inflation front. And after the CPI data yesterday, Warsh said that the data did not make him think that it's mission accomplished or that everything is swell. So it doesn't seem to be the case that Warsh believes that we're on a disinflationary trend quite yet. And obviously, the market continues to price some probability of Fed hikes here for the year. As I look at screens, just recording kind of mid Wednesday afternoon, markets pricing around 24, 25 basis points worth of hikes by the Fed through the end of the year. For perspective, before things got going earlier this week with the CPI data and Warsh speaking, the market was closer to around 42 basis points. So we've definitely seen some air come out of the tire, but the market is still leaning towards hikes as opposed to cuts. Equities continue to generally keep things in stride. And what was interesting to me is Tuesday morning after the CPI data, not surprisingly, we saw yields move significantly lower after a much larger than expected downside surprise in the CPI data. But throughout the day on Tuesday into the afternoon, we saw the market bid back. And so we saw kind of coming into the North American Open today, Wednesday, that 10-year yields were actually flat versus where they were 24 hours ahead before the CPI data came out. And 2-year note yields had also climbed back by at least a half of what they had fallen on Tuesday, which again, I think is quite telling. So there's clearly a large camp in the market that thinks that yields need to be higher. I would generally be in that camp. And this idea that curve it probably needs to be elevated. And it's a challenging time to be buying nominal duration. But equity markets and risk continue to trade relatively well. We're obviously in the middle of earnings season. And the AI capex story, which we've obviously leaned into very heavily since last fall, and US exceptional growth has clearly come through and has helped to power, obviously, not only the economy, but also, I would say, equities to an extent. And I have no reason to necessarily move away from that at this point. Maybe quickly on Bank of Canada here, having released its decision this morning. So Bank of Canada, no change in rates, as was generally expected by us and the market. And this was the July meeting, of course, and this was a forecast meeting for the bank. So we had the MPR, the Monetary Policy Report. So it was a little bit more kind of detail that the bank releases on obviously the forecast meetings as opposed to the non-forecast meetings. Key to me, I think, on the bank side is this idea, of course, that what does the bank think about the output gap? The output gap, not a lot of central banks use this anymore. It used to be a lot more prominent maybe 20, 25 years ago, but banks have kind of moved away from output gap as a big metric and input into their policy reaction function, but the bank still uses it for better or worse. And the bank continues to believe that the Canadian economy will be underperforming, or as they would say, excess supply for the foreseeable future into 2028. And with today's update, and this was the first update since the April meeting on the outlook policy side, of course, there was a meeting in June, but from a forecast perspective, the first one since April, they thought that the output gap, the underperformance of the economy was actually going to be larger than they had anticipated over the projection horizon than they thought in April. So that to me is generally a dovish sign. But the bank, I think, probably spent a fair bit of time, not only in the statement, but also in the MPR and also in the press conference, what I would characterize as cutting the tail risks down on both sides. And so you might recall over the last couple of meetings and maybe even into early Q1, the bank was talking about, well, we could hike rates under X scenario and we could cut rates under Y scenario. And the X scenario for hiking rates was clearly, and particularly since late Q1 when hostilities got going in the Middle East, was when if oil prices moved higher, then the bank would need to hike rates maybe at least once, if not twice. Downside scenario was generally around USMCA. And if there was going to be a big issue around USMCA, and obviously we've had July 1st come and go, and there hasn't really been a major change in terms of what's been happening in supply chains. Obviously, there's been a change in terms of how it's done. Clearly, not everybody signed it. US did not want to get involved in signing it. So there's going to be discussions and kind of a renewal every year for the next 10 years, unless one country or more than one country pulls out of the agreement with 6 months notice. But USMCA is not kind of the big downside risk. And so I think that for the bank was the big downside concern in terms of how could the bank end up cutting rates. And obviously I have had an outsized view and a non-consensus view for a while here on the bank that it would cut rates once, possibly twice in 2026. Originally in 2025, I thought that might happen by June. And then as we moved into early in the new year, I thought that might happen maybe in July. Of course, this was the July meeting. That has not happened. And I think with the bank, again, kind of cutting the tail risks off. So the big upside risks are not as prevalent and the big downside risks are not as prevalent. I think the risk of the Bank of Canada cutting rates this year in 2026 has declined. And while not formally changing views here, I'm probably closer to 45% that the bank will cut rates this year. So it's certainly a risk that the bank could cut rates. And there's a few reasons, and I'll talk about that in a sec. But it's probably moving away from my base case that the bank will cut rates this year because the bank believes, and it could be wrong, of course, but the bank believes that this weak economic period that we had in Q4 and Q1, where we had two consecutive quarters of negative real GDP growth, and by some definitions, a technical recession, the worst in the growth cycle is behind us. And the bank sees a decent amount of upside here for the back half of 26. And I would actually even say Q2 26 and into 27. Now, of course, that may or may not end up being true, and we'll see what we get. But that's what the bank is thinking. And so all other things equal, I have to just take the probability of the bank cutting rates off the table. What I think the bank could be missing, and my colleague Andrew Vasila has done a lot of fantastic work on this, is around the population growth in Canada. So we've talked a little bit about population growth, and in particular, in this case, population decline in Canada. Canada saw a population decline in Q3 2025, as most people know. Q4 2025 and a very small population decline in Q1 2026. I don't believe we have the numbers yet for Q2 2026, just being kind of early July here. But the population has been declining in Canada. A lot of that, not all of it, but a lot of it is the immigration story. But it's certainly not all about the immigration story. And as my colleague Andrew would note, and he noted this morning, so this is really me borrowing from his excellent work, what we've seen so far in terms of population decline have been not all, but heavily based on the student side. And of course, the student side is very important in terms of consumption and that sort of thing, but not necessarily working in the economy. The next phase of population decline via the immigration kind of stream could be more on the temporary foreign worker side. And if that's true, then that could be a little bit more challenging in terms of economic growth in Canada and contributions to GDP. My view, which is really a textbook view, so it's not necessarily earth shattering, but my view is generally that it's very, very difficult to have trend GDP growth for a prolonged period of time, and definitely above trend GDP growth for a prolonged period of time if your population is declining. And I don't see a lot from this government suggesting that it's going to change the immigration rules and macroprudential measures in the short-ish term from a government perspective, which I would mean quarters from now. And if that's true, then I'm not entirely convinced that the bank is taking that variable into account as much as I would, and maybe we would as a team. So there's some downside risk there, I think, from an economy perspective, from a spending consumption perspective, that I'm not sure the bank is spending as much time on, or at least values or views it as downside risk as we would. So it's one of the reasons why I would continue to not completely disregard the idea of a Bank of Canada cut in 2026. But, to be fair, given everything that I've seen, and obviously also the oil prices moving higher over the last week or two, again, higher for longer. We've talked about that on these podcasts. And what Governor Macklem has said today, it would be inappropriate for me to kind of continue, I think, to consider that the base case is going to be cuts, but it's certainly not going down to a 5% or a 0% probability for the year if we are correct on the overall population decline story. But other than that, I thought the Bank of Canada decision was relatively evenly balanced. We've seen the market move a little bit here in terms of pricing. The market is now pricing about 17 basis points worth of hikes for the Bank of Canada through the remainder of the year. So slightly less, but in the same neighborhood as where the Fed market pricing is at the moment. But we will continue to get important data throughout the next week or so. And obviously, Jackson Hole for the Fed in late August will be very important from a policy perspective, as well as the FOMC meeting later this month, closer to the end of July. We'll be back with our next Market Exchange podcast around the time of the FOMC meeting, where we'll talk about what the new chair did, what the Fed outcome was, what our outlook is, what we think about markets, and provide a general update. So until then, thanks very much for listening to the latest edition of Market Exchange with Mackenzie Investments. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.